Chapter 6A contains deductions. These deductions you have to claim on the gross total income. All the deductions that are mentioned in this chapter can be claimed only in the old tax regime. In the new tax regime, only 3 deductions can be claimed: 80JJAA, 80CCD subsection 2, 80CCH subsection 2. No other deduction can be claimed in new tax regime. Because of chapter 6A deduction, you cannot get a loss. Now, chapter 6A deduction is not allowed against a special rate of income, only allowed against a normal rate of income. So, it means what? Gross total income, take the gross total income. From this, you remove the special rate of income. Whatever is remaining, that is only the maximum limit for chapter 6A deduction. You get my point? Now, first chapter 6A deduction is section 80C. Section 80C, investment in specified assets. Chapter 6A deductions are there, no? There are 3 types of chapter 6A deduction: payment based deduction, income based deduction. Payment based deduction and income based deduction. And in income based deduction also there are normal income based deduction, certain income based deduction. Normal income based, certain income based. They have given 80JJAA, which is a payment based deduction in this certain income based deduction category. Now let's come to life insurance premium. Life insurance premium is allowed as a deduction under section 80C. Firstly, let me tell you about the 80C limit. In 80C, no, there are so many options, different type of investments that you can do. This all is to encourage the saving habit in the taxpayers. Okay, the government wanted the taxpayers to save some money and invest in good types of assets. That is why they introduced 80C to encourage them. Hence, you will find different options under 80C. But all of these options combined, maximum limit is how much? 1,50,000. 1,50,000. So, the maximum limit of investment that can be done aggregate in 80C is how much? 1,50,000. Also, you are going to study one more section called 80CCC. 80CCC. And also one more section you are going to study, 80CCD subsection 1. So 80C, 80CCC, 80CCD subsection 1, all these 3 sections also combined limit is maximum 1,50,000. Okay. So 80C, 80CCC, 80CCD subsection 1 combined together maximum limit is 1,50,000. It is given in 80CCE limit. 80CCE in or section irukku. There it is given 80C, 80CCC, 80CCD subsection 1, maximum 1,50,000. So this is the upper limit of claiming the deduction under these 3 sections combined. Now let's come back to 80C. In 80C, the first and most important deduction that we are going to learn is life insurance premium. Life insurance premium. Life insurance premium which is paid is allowed as deduction under section 80C. However, subject to limits. There is a maximum limit in this life insurance premium also. There is a maximum limit of the section 80C. There is maximum limit for 3 sections combined, that is also 150. In this life insurance also there is a limit on premium that you can claim as deduction. What is the limit, sir? Before 1/4/2012, if you have taken a policy, then actual premium or 20% of the sum assured. Take the sum assured and take 20% of sum assured, whichever is lower is the limit. Sir, what if the premium is above the limit? Then deduction can be claimed up to limit. If premium is above the limit, deduction cannot be claimed. No. Deduction can be claimed up to the limit. Limit varaikum deduction claim pannikalam. Prachana illa. Okay va? Next. If the policy was taken from 1/4/2012 up to 31/3/2013, or you can just say after 1/4/2012, the limit was changed from 20 to 10%. Then from 1/4/2013 onwards, they gave a benefit only to 80DDB, 80U category persons. The persons who are covered under 80DDB and 80U, for them alone, the limit was increased to 15. So what was the limit? Before 1/4/2012, it was 20. After 1/4/2012, it was 10. Then from 1/4/2013, they gave benefit to 80DDB, 80U. that for you alone the limit is increased to 15. Sure, should I remember the limit? Yes. Should I remember the date? Yes. You should remember limit also, date also, because in the question they will play with the dates when it is given in examination. Before 1/4/2012, limit was 20% of sum assured. If policy is after 1/4/2012, it became 10% of sum assured. But from 1/4/2013 onwards, it became 15 only for 80 DDB and 80 U persons. Okay. Now, if you are paying a premium within the limit, entire premium allowed as deduction subject to 150 limit. But if you are paying more than the amount, more than the limit, then only up to limit it is allowed. The higher amount is not allowed as deduction. Then, for whom can you pay this premium? This premium can be paid for individual himself or herself, then spouse of individual, children, and for HUF can pay for members. So HUF can pay LIC premium for members, individual can pay LIC premium, life insurance premium for spouse and children. Only spouse and children. Inga family are spouse and children. See, family definition in many places there are different definitions. Adu ninga konjo careful ah paathukanum. Okay va? Now, if contract is cancelled within 2 years, then entire deduction allowed earlier will become deemed income. This is not that important point, but still, if you stop paying the premium, if you cancel the policy within 2 years itself, then whatever deduction that you had already claimed, that will be deemed income. Okay. Now comes the important part, section 1010D. Now we are going to discuss about the taxability of life insurance premium. Taxability of life insurance premium. Firstly, generally life insurance premium is exempt. Maturity from life insurance policy is exempt. Generally, maturity amount that is received from life insurance policy is exempt. But if it is crossing the limit, which limit? The limit that we studied now. If the premium is crossing the limit, in such case, the life insurance maturity is taxable. Okay. Generally, life insurance maturity is exempt. But if life insurance maturity is crossing the limit, then it is taxable. Fine. Then, from 1/4/2023 onwards, exemption would also not be available if the amount of premium exceeds 5 lakh rupees for any of the previous year during the term of such policy. In case where the premium is payable by a person for more than one life insurance policy other than ULIP, and the aggregate premium on such policy exceed 5 lakhs for any of the previous year during the term of such policy, exemption would be available in respect of any of those life insurance policy other than ULIP at the option of the assessee whose aggregate premium payable does not exceed 5 lakhs for any of the previous year during the term. So, enna pannirukanga from 1/4/2023 onwards, if the life insurance premium is more than 5 lakhs, then maturity is taxable. Life insurance premium is more than 5 lakhs, maturity is taxable. Sir, what if it is less than 5 lakhs? Then you see the limit, what I told you, that 20%, 10%, 15% limit. If it is within the limit, it is exempt. If it is above the limit also, it is taxable. Okay. So, more than 5 lakhs not taxable. But this more than 5 lakhs, no, it is aggregate premium. So, what if I am having 3 life insurance policy? I am having total 3 policies. In one policy I am paying premium of 2 lakhs, one policy I am paying premium of 3 lakhs, another policy I am paying premium of 4 lakhs. For this, the sum assured is 1 crore, for this the sum assured is 2 crores, and for this the sum assured is 5 crores. So, I am paying 2 lakhs, 3 lakhs and 4 lakhs. I am having 3 policies. 3 policy irukku. 3 policy ku vandu one policy I am paying 2 lakh rupees as premium, another policy 3 lakh rupees as premium, another policy 4 lakh rupees as premium. Now, all the 3 policies are within 5 lakh limit, but 5 lakh limit is there, no, that we should see for aggregate policy. So, total is how much? 9 lakhs. Total premium paid is how much? 9 lakh rupees. So, am I crossing the limit? Answer is yes, I am crossing the limit. Fine. So now what I can do is, I can choose any policy which is within the limit, any policy which is within the limit, and that policy or amount I can choose it as exempt. Balance policy will become taxable. Purida? So for example, I can choose policy number 1 and policy number 2 as exempt, and policy number 3 will become taxable. But here what will be sensible? Sir, 2 plus 3 5 ஆயிருச்சு sir. So 5 lakhs exempt treat பண்ணிக்கலாம், 4 lakhs taxable எடுக்கலாம். Should we do like this? Answer is no. We should not do like this, because you see what is the definite amount that you are going to receive, because exemption will be on maturity only, no? So see the maturity value that you are going to receive, where you are getting highest benefit, that you take. Okay, where you are getting highest benefit, that you take. Sir, here I am getting highest benefit 5 crores. Here both combined also I am getting benefit of only 3 crores. So I will take 5 crores, and this 4 lakh, no, I will claim it as exempt. Balance this 2 lakh and 3 lakh I will claim it, put it as taxable policies. Purida? Now listen, sir, 4 lakhs na exempt claim பண்ணிருக்கேன், இன்னும் 1 lakh gap is there. So this gap, can I do this 2 lakhs? No, I will claim 1 lakh as exempt, 1 lakh as taxable. So half maturity will be exempt, half maturity will be taxable. அந்த மாதிரி பண்ண முடியுமா? Like that and all you should not do. Okay, so whatever full policies are coming within the 5 lakh limit, that much only you can take it as exemption. Okay, half exemption, half taxable, like that and all, it is not allowed. So you see, total number of policies, if the aggregate premium is crossing 5 lakhs, in such case the only up to 5 lakhs premium you can claim exemption. For the balance policies it will be taxable, and it is the choice of the assessee to claim the exemption. Now listen, sir, amount received on death is exempt. Amount received on death, life insurance amount which is received on death, in any case whatever the premium may be, if a maturity amount is received on death, then it is fully exempt. Next, key man insurance policy is not exempt. We already saw it is taxable under 3 heads of income. It is not exempt. Then if sum is received for a person under section 80DD, you are going to see, if life insurance maturity is coming for them, then also it is not exempt. Then if the life insurance is a unit linked insurance plan, ULIP, if the life insurance policy is a unit linked insurance plan or ULIP, in such case from 1/2/2021, the same story that I told you, no, 5 lakhs story, for ULIP it is a 2,50,000 story. Same story, aggregate amount you have to see 2,50,000. If it is more than aggregate up to 2,50,000, you can choose exemption. Balance will become taxable. Balance will become taxable. But listen, what is ULIP? First and foremost, ULIP means unit linked insurance plan. So they will get the premium from you, and this premium, no, they will invest in the market. Then in market, whatever returns they get, no, based on that only you will get the maturity. Okay, this is only unit linked insurance plan. So this is like a insurance and investment mixed with each other. So what people were doing, instead of putting in capital asset, instead of buying financial instruments, securities, etc., people were buying ULIPs, because maturity on ULIPs was exempt, subject to the 10%, 15%, 20% limit. It was exempt. So from 1/2/2021, they made ULIPs as taxable. After ULIP became taxable, now then life insurance companies now started coming with scheme that now you take our other policy, there we will give you good returns. It is not ULIP, but we will give you good returns. So it was a life insurance premium and investment mixed with each other. So now there also they brought a limit of 5 lakhs. Purida? So first day or limit irukku. The first layer, second layer, third layer. First day or limit irukku. Enna limit? 10%, 15%, 20%. Before 1/4/2012 it is 20. After 1/4/2000, on or after 1/4/2012 it became 10. Then from 1/4/2013 onwards, for 80DDB and 80U alone it became 15. Correct? Now if it is within the limit, no problem, maturity is fully exempt. If it is above the limit, then it is fully taxable. But within the limit rinda, it should be within the, now you have to see whether it is a ULIP or not a ULIP. ULIP ayirunda it should be within 2,50,000. Aggregate should be within 2,50,000 limit, and not a ULIP ayirunda aggregate should be within 5 lakh limit. Okay, then you have to find out the income and tax. Now ULIP taxation is, ULIP is taxed under capital gains. Life insurance policy is taxed under, other than ULIP is taxed under income from other sources. ULIP is taxed under capital gains. Life insurance policy other than ULIP is taxed under income from other sources. ULIP taxation is a CA final syllabus, not there in your syllabus. Apada, at least that much relief. Life insurance policy other than ULIP, it is there in your syllabus. Okay, now I want you to take a full page and see this chart is there. No, this I want you to draw. Paatha dhaan bayama irukku, but actually very, very simple. Okay, listen, this chart, no, only for looking, it is looking like a huge chart, but it is very, very simple. When you have put itself, you would have understood. So what did I tell? That there are 4 policies. So there are 4 types of limits. Actually only 3 types of limits. Before 1/4/2012, it was 20% or sum assured, whichever is lower. So premium can be up to 20% of sum assured. In such case, no problem. If premium is more than 20% of sum assured, then the maturity will be taxable. Okay, then from 1/4/2012 onwards, this limit of 20 became 10. So if premium is up to 10%, it is fully exempt. More than 10%, it is taxable. Then on or after 1/4/2013, for disease under section 80 DDB and 80U, disease or disability alone, they brought a 15% limit. If the premium is up to 15% limit, it is exempt. Illana, it is taxable. Now you see, if the conditions are satisfied or not satisfied. Okay, let's say the condition are not satisfied. The conditions are not satisfied. Then what did I tell? It is taxable. But you have to see it is taxable under which section. In capital gain or income from other sources. If it is a ULIP, it is taxable under capital gain chapter. If it is not a ULIP, then taxable under income from other sources chapter. So if conditions are not satisfied, it is taxable. But in the chapter la taxable, capital gain or IFOS, it is taxable under IFOS if it is not ULIP. If it is ULIP, it is taxable under capital gain. ULIP is covered in CA final level. Now, sir, what if conditions are satisfied? If conditions are satisfied, no, directly you cannot call it exempt. Then you should see whether it is within the 2,50,000 or 5 lakh limit. First, let us see what is the 2,50,000 limit. You should see whether it is a ULIP or not a ULIP. ULIP na 2,50,000 limit will apply. Not a ULIP na 5 lakh limit will apply. Now let's come to ULIP. ULIP irunda, if ULIP is before 1/2/2021, then ULIP is also completely exempt. Policy is also within limit. ULIP also before 1/2/2021, fully exempt. On or after 1/2/2021, what will happen? You can take aggregate policy premium 2,50,000 as exempt. Balance amount will become taxable under capital gain. Okay. Then, in case of other than ULIP, na, if it was before 1/4/2023, it is fully exempt. On or after 1/4/2023, if the policy is issued on or after 1/4/23, see, premium on or after 1/4/23 illakana, policy itself on or after 1/4/2023. Okay, in such case, aggregate premium up to 5 lakh rupees exempt. Aggregate premium more than 5 lakh rupees, then up to 5 lakh rupees is exempt. More than 5 lakh rupees is taxable under 56(2)(13). Now let us see 56(2)(13) in income from other sources. 56(2)(13). Sum received by way of bonus from life insurance policy other than ULIP and keyman insurance policy. Keyman insurance policy, na, it will be taxable normally under salary, PGBP or IFOS, however it may be. Other than keyman insurance policy and other than ULIP. ULIP is taxable under capital gain, not covered for CA inter syllabus, only for CA final. Now, other than ULIP, we are going to see. Where a sum is received including the amount allocated by way of bonus at any time during the previous year under a life insurance policy other than ULIP, other than Keyman insurance policy, which is not exempt under section 1010D. So ULIP இருக்கக்கூடாது, Keyman insurance policy இருக்கக்கூடாது, exempt இருக்கக்கூடாது, taxable இருக்கணும். Sums were received as excess the aggregate of the premium paid during the term of such life insurance policy and not claimed as deduction under other provisions of the act computed in the prescribed manner would be chargeable to tax income from other sources. So how to compute income? Income is equal to amount received minus premium paid on which deduction is not claimed. Amount received from the maturity, okay, minus you can reduce what? Premium paid you can reduce because that is the payment made. So balance only is the income, no? So whatever LIC amount received minus premium paid is only the income. This is taxable. But if you have taken deduction on premium, such premium you should not take. If you have taken deduction under 80C, if you have taken deduction on premium, such premium you should not reduce. Okay, wow. Now life insurance premium, we saw we can take a deduction under section 80C subject to limits, and maximum 80C limit is how much? 1,50,000. Now what are all the other items? Let us quickly cover what are all included in 80C. Number 1, payment of tuition fees. Tuition fees means what? Tuition fees of school. Tuition fees na school ku appuram pora tuition kedaiyadhu, school la pora tuition fees. Whatever tuition fees is paid for the school is called tuition fees, and it is allowed for maximum 2 children of the individual. Sir, individual paying tuition fees for himself, school fees for himself, is it allowed? No, only children tuition fees is allowed. Next, tuition fees is only allowed, not any other payment. So donation fee, capitation fee, sports fee, lab fee, in the fee and the fee adala allowed kadiyadu. Tuition fee component alone will be allowed as deduction under 80C. It is not for private tuition, it is only for school, university, college and other institutions. Then institution should also be situated in India. So the school fee paid in India is only allowed as deduction, not in India, not allowed. Then repayment of housing loan. So if a housing loan is repaid, see interest we saw, interest is allowed as deduction under section 24B, income from house property chapter. Okay, wow. Then repayment is also allowed as deduction under section 80C of housing loan. But when we saw 24B deduction, I told you that the loan can be taken from anyone. It can be taken from friends also, relatives also. There is no limit. But here it is only allowed if the loan is taken from the institutions. Okay, wow. Just give a reading. Fine. Next, stamp duty or registration fees for the purchase of house is also allowed as deduction under section 80C. So for example, while purchasing a house, 1 crore house, 9% is, let's say, the stamp duty. 1 crore house na 9 lakh rupees I have paid as stamp duty. That stamp duty la 9 lakh rupee pay pannirkenla, 150 you can claim here as deduction. 150 is maximum. Next, contribution to statutory provident fund, recognized provident fund, public provident fund. We have already seen employee contribution na, then you can claim it as deduction under section 80C, and not only for self, for family also. Family is same as life insurance premium. So spouse plus children. So spouse ku na PPF katra, children ku PPF la amount pay pandrena, I can claim it as deduction. Next, 5-year deposit. So 5-year FD is 5-year FD nu solvangala, tax saver FD. This is only the tax saver FD. You put it in a fixed deposit where there is a lock-in period of 5 years. Then you can, whatever amount you are putting in deposit, no, that amount you can claim as deduction under section 80C. But will this interest be taxable or exempt? The interest will be taxable. And the 5-year FD irukla, adoda interest taxable? Answer is yes, that is taxable. Then contribution to additional account, tier 2 account under NPS. See kanna, in NPS no, there is tier 1 account, tier 2 account. Tier 2 account la vande, if central government employee is investing 80CCD1, 80CCD1B1 and 80CCD2, 3 section subsection nanga paaka porom. In those 3 subsection, it only speaks about tier 1 account. It doesn't speak about tier 2 account. If amount is invested in tier 2 account, then if central government employee is investing the amount, then he can claim deduction under 80C. 80C. Next, contribution to approved superannuation fund, unit linked insurance plan of mutual fund, LIC, or unit linked insurance plan of LIC. So ULIP of LIC is also allowed. notified pension set up by mutual fund or UTI, approved annuity plan of LIC, Sukanya Samriddhi account. Sukanya Samriddhi account also very common for the daughter child till the daughter attains 18 years of age. It can be deposited in Sukanya Samriddhi account. One more point about Sukanya Samriddhi, interest is exempt. Okay. Then senior citizen savings scheme. Then National Housing Bank. Subscription to National Savings Certificate and interest on National Savings Certificate. See, interest on National Savings Certificate can also be claimed as deduction. Interest received on NSC can also be claimed as deduction, but first it is taxable. First taxable and then deduction. So first add it to income, then you claim it as deduction. Then notified unit of mutual fund or UTI, certain equity shares or debentures with a lock-in period of 3 years, certain units of mutual funds, deposit scheme of public sector undertaking, authority engaged in housing finance or finance for residential houses. Example, deposit scheme of HUDCO. Then notified bond issued by NABARD, premium paid for deferred annuity contract, salary deducted by government employer for deferred annuity. So இதெல்லாம் ஞாபகம் வைக்கிறது ரொம்ப கஷ்டம். Go through it 2 times, 3 times, 4 times. So if it is coming in examination, உங்களுக்கு click ஆயிரும் that I have to take 80C deduction for old scheme. Okay. Next, 80CCC, contribution to pension fund of any insurer. Contribution to pension fund of any insurer. And now we also already saw pension fund. If the pension fund is set up by mutual fund or UTI, then it is coming under 80C. If it is the pension fund of any insurer, then it is coming under 80CCC. But 80C ஞாபகம் இல்ல, 80CCC ஞாபகம் இல்ல, ரெண்டுமே ஒரே ட்ரீட்மெண்ட் தான். Just put 150 maximum deduction and move on. Okay. Section number எழுதாதீங்க, அவ்வளவுதான். Eligible யாரு? Individual. Maximum 1,50,000. Now let us see 80CCD. 80CCD is what? Contribution to NPS, new pension scheme or national pension scheme or new pension system trust or central government pension scheme or Atal pension yojana. Ella one தான். Everything is one. Central government pension scheme, Atal pension yojana, new pension scheme, national pension scheme, new pension system trust, everyone is one and the same. Okay. Now there is 80CCD subsection 1, 80CCD subsection 1b, 80CCD subsection 2. 80CCD subsection 1, 1b and subsection 2. 80CCD 1 is included in the 150 limit. 1,50,000 limit kulla 80CCD 1 is included. 80CCD 1b gives extra 50,000 limit. 80CCD 1 also employee contribution. 80CCD 1b also employee contribution. 80CCD 1 also employee, 80CCD 1b employee. 80CCD 1 is covered in 150 limit. That is 80C plus 80CCC plus 80CCD subsection 1. Ella மூணுமே சேர்ந்து 1,50,000 is the maximum allowed. 80CCD 1b is a extra 50,000 limit. Then 80CCD 2 talks about employer contribution. Employer contribution தான் allowed in both old tax as well as new tax. Only employer contribution is allowed in old tax regime also, new tax regime also. Fine. Here it is 80CCD 2 allowed in section 115 BAC. Now listen, let us see what are the limits. For employee contribution, there can be employee also, self-employed also. Self-employed also. In case the person is an employee, then 10% of salary. What is salary? Basic plus DA terms. What is salary? Basic plus DA terms. This is the same salary that you studied in section. Oh, what is this pen? This is the same salary which you had studied in the section 36 when we discussed the PGBP deductions, employer contribution to deduction. Angayum basic plus DA terms 14%. Here also same basic plus DA terms, employer contribution case la 14%. Now listen. Employee contribution, what is the limit? 10%. Okay. Self-employed na 20% of GTI. So pension scheme, what is the maximum limit? 10% of salary, 20% of GTI in case of self-employed. and over this also there is the upper cap of 150, and this 150 includes 80C also, 80CCC also. Purida? So listen carefully. Employee contribution, 10% of salary is the maximum limit. 10% of salary. What is salary? Basic plus DA terms. This is the maximum limit. This maximum limit ke mala there is another maximum limit which is 1,50,000, and this 1,50,000 is the combined maximum limit of what? 80C, 80CCC, 80CCD subsection 1. Purida? So all combined for a maximum limit. Then self-employed, 20% of GTI. This is also included in the 150 maximum limit. Then 80CCD 1B. 80CCD 1B. Here also employee contribution 50,000 is allowed as deduction. 50,000 is allowed as deduction. So sir, if I am having employee contribution, where will I put the deduction first? 1B or 1? Always put under 1B first. So this is rank 1. Please put here rank 1, and this is rank 2. Rank 1 and rank 2, because 80CCD subsection 1 it is included in the 1,50,000 limit. So anga so many limits are there. Here 50,000 fully you can claim. This 50,000 is exclusively there only for what? 80CCD subsection 2 only. 50,000 limit. Where in the section ko share panna de in the limit. That is why first to claim this 50,000, balance amount you look to claim in 80CCD subsection 1. If at all there is an employee contribution. Fine. Now let's talk about employer contribution. In case of employer contribution, maximum employer contribution allowed as deduction is 14% of salary in case of central government, state government employee, and in case of other than central government, state government employee, it is 10% in old regime and 14% in new regime. 10% in old regime, 14% in new regime. So this is the third place where benefit is given in 115 BAC. Third place where benefit is given in 115 BAC. Generally benefit is not given, but there are three places where benefit is given. Standard deduction, then second one is family pension, third one is employer contribution to NPS. Okay. Now, sir, this new pension scheme, some special points. Conversion from pension scheme to annuity plan will not be deemed as income. Then closure. Okay, we will see this one. Section 10, clause 12A. Listen, pension scheme vande neenga close pandringa. If it is getting closed, then whatever amount you are withdrawing, out of that amount 60% will be exempt, 40% is taxable. When NPS is getting closed, 60% exempt, 40% taxable. Then you are partially withdrawing. Then if suppose there is 10 lakh rupees in the NPS, you want to partially withdraw, fulla close panna venda, you want to partially withdraw the amount na, you withdraw up to 25%, it is fully exempt. So evlo withdraw panikalam maximum 2.5 lakhs withdraw panikalam. So NPS la 10 lakh rupees is there. From this 10 lakh rupees I want to withdraw some partial amount, then you can withdraw up to 25% fully exempt. Okay. Then if RPF and approved superannuation fund is transferred to new pension scheme, then there is no tax. Next, ATD, Mediclaim, medical insurance premium. Medical insurance premium. Here you can write Mediclaim also. Ella, I know these deductions you have already seen. That is why quickly I am finishing off everything. And not much to learn also. Everything is to by heart, memory. But this chapter, memorizing la poning na, if you look to memorize everything, it will be very difficult because so much content is there. So what is a better manner, better way is to give a reading, 3 readings, 4 readings, 5 readings kodunga, till you feel that you are confident that in the exam hall you will be able to do the correctly, do everything correctly. Then some portion you definitely have to memorize. For example, in 80C, you have to memorize that dates 1 for 2012, 2013 and etc. So all those things you memorize. Now, Mediclaim, type of expense, individual HUF. So medical insurance premium that is paid, no, that is allowed as deduction under section 80D. Under section 80D. If an individual is paying medical insurance premium for self, spouse or dependent children, self, spouse or dependent children, then the aggregate premium allowed as deduction is 25,000. Aggregate premium allowed as deduction is 25,000. However, out of the self, spouse and dependent children, if anyone is senior citizen, then this 25,000 will get increased to 50,000. Additional 25,000 also you will get if anyone is senior citizen. So if any one of the self, spouse and children is senior citizen, then additional limit of 25,000, total limit will become 50,000. Then for parents there is a separate limit of 25,000. For parents there is a separate limit of 25,000. So if you pay medical insurance for parents, separately you can claim 25,000, and if parents, even one of them is a senior citizen, then this separate limit also will be increased to how much? 50,000. Extra 25,000 will be received. So maximum how much? 1 lakh. Maximum deduction in Mediclaim 80D is how much? 1 lakh. A person can claim a deduction of maximum 1 lakh. Adhikku mele can a person claim? Answer is no, not possible. Okay. Now, if you are doing medical expenditure for parents, that is also allowed as deduction. Sometimes what will happen, if the age is more, the insurance company will not give any insurance, okay, or the insurance premium will be too high. In such case, what will happen? Insurance cannot be done. Hence, medical treatment is allowed as deduction. But is there any separate limit for medical treatment? Answer is no. For this parent, there is a limit of 50,000. No. Medical treatment also included in the limit of 50,000. Medical treatment also included in the limit of 50,000. Even for self, spouse and dependent children, if there is senior citizen, this medical treatment is allowed only for senior citizen, and that is also included in the 50,000. Fine. Now, health insurance, preventive health checkup. Preventive health checkup. Preventive health checkup can be done for self, spouse, dependent children as well as parents. For all of them, combined limit of 5,000. Combined limit of 5,000. This 5,000 is included in the 50,000 limit. So even in spite of 5,000 being there, the maximum deduction cannot cross how much? 1 lakh. Maximum it is 1 lakh only. So if I am senior citizen, my father also senior citizen, so maximum 1 lakh can be claimed as deduction. I am also senior citizen, my father also senior citizen. So me, my wife, my children, for all the family members put together, 50,000 is maximum, and my mother and my father 50,000 maximum. Total how much? 1 lakh. This 1 lakh also includes medical treatment expenditure. This 1 lakh also includes 5,000 rupees preventive health checkup. Okay, wow. So preventive health checkup of 5,000 maximum. So preventive health checkup maximum how much? 5,000 rupees. It is included in these limits. Okay, self limit, parent limit. Now, see, above payment except preventive health checkup shall be made in any mode other than cash. So preventive health checkup alone you can pay in cash, but medical insurance premium and medical treatment you should pay in any mode other than cash. See, here I am not using prescribed mode. Account pay check, account pay adala kadayadu. Cash irukka kudadu. Avladhan. It should not be cash. In entire deduction chapter, only in one section you will see prescribed modes. That is 80JJAA. Okay, wow. Account pay check, account pay bank draft, electronic clearing system, NEFT, RTGS. Okay, all those you will only see in what? 80JJAA. In all the other sections, it will be given as other than cash. If at all it is given, it will be given as other than cash. So in Mediclaim also, premium or medical treatment should be other than cash. But preventive health checkup can be in cash also. Sir, what if I gave lump sum premium? I took 3 years policy or 4 years policy. Then what to do? Then you can take the deduction on proportionate basis. How to calculate proportion? Premium plus year of payment plus subsequent years in which the insurance will be in force. Okay, now let's come to 80G. all the important deductions I am finishing first. Adukaprom not so important, quick mudichirlam. So 80C was important, finished. 80CCD was important, finished. 80D was important. 80G is also important. 80G also important. So listen, when you are making a donation under section 80G, there are 4 types of limit, 4 types of donation that you can make. 100% unlimited, 50% unlimited, 100% limited, 50% limited. 100% unlimited and 50% unlimited means what? Whatever, how much ever donation you make, fully it will be allowed as deduction. That is 100% unlimited. And 50% unlimited means what? How much ever donation you make, 50% of that donation will be allowed as deduction. Then limited category means what? You have to find out the limit, which is adjusted qualifying income. That qualifying income is what? 10% of adjusted total income. Qualifying limit is 10% of adjusted total income. So this 10% of adjusted total income is there, no? That is only maximum amount of donation. Okay, for both 100 as well as 50 combined, that is only maximum donation that we are going to find out. And this only will be allowed based on 100% or 50% category. Okay. Now, sir, who are all covered in 100% unlimited category? I have given you some keywords: PM, CM, National, State, Army, Clean Ganga, Swachh Bharat. All these keywords, if you see, most probably you will be able to identify that it is a 100% unlimited category. 50% unlimited donation. So here there is only one fund. Earlier there used to be 4. Now there is only one fund. Prime Minister Drought Relief Fund. So idu nyabam vechukonu. Prime Minister Drought Relief Fund. If it is the Drought Relief Fund, then how much ever donation you do, 50% will be allowed as deduction. Now let's come to 100% subject to qualifying limit. Family Olympics. So first one is what? Government or to any other approved local authority institution for promotion of family planning. Sum paid by a company as donation to the Indian Olympic Association or any other association institution established in India as may be notified for the development of infrastructure for sports or games or the sponsorship of sports and games in India. 50% subject to limit. 50% subject to limit is only most common. Any institution for or fund established for charitable purpose. Then government or any other local authority for utilization for any charitable purpose other than the purpose of promoting family planning. Because family planning mala cover aichu 100% la. Authority constituted in India by or under any law enacted either for dealing and satisfying the need for housing accommodation or for purpose of planning, development or improvement of cities, towns, villages or both. Then fourth one, any corporation established by the central government or state government for promoting the interest of the members of minority community. And then last one, renovation or repair of notified temple, mosque, gurudwara, church or any other place of historical, archaeological or artistic importance or which is a place of public worship of renown throughout any state or states. Okay, so these 5. A keyword: charity in temple and housing for minority. Charity, temple, housing, minority. So temple na temple, mosque, gurudwara, church ellame vanduru. Then charitable trust will come. For the purpose of housing will come. For the purpose of minority community will come. For all this, 50% subject to limit. Now what is this limit karna? To compute the limit, first you have to calculate adjusted total income, and the limit is 10% of adjusted total income. What is adjusted total income? This adjusted total income is different from the adjusted total income that we studied in AMT. AMT is different. This is different. Okay. Adjusted total income is equal to gross total income minus chapter 6A deductions except ATG. So other than ATG, all the chapter 6A deduction you should reduce from gross total income, and minus short term capital gain under section 111A, long term capital gain under section 112, 112A, 115BB, 115BBE. So all the special rate income also you reduce. Take the gross total income, reduce the deduction, accept 80G and reduce all the special rate income. You will get adjusted total income. Take 10%. This is only called qualifying limit. Qualifying limit. This qualifying limit kanna is the limit of donation. It is not the limit for deduction. It is the limit for donation. So deduction, no, you have to be within the limit. Hence, you have to do ranking. So ranking la vandu first rank you give to 100% deduction category, second rank you give to 50% deduction category. First preference to 100% deduction category, second preference to 50% deduction category. So if it is more than the limit, if the donation that you have done is more than the limit na, then you should come within the limit, no. So for coming within the limit, first preference you give to 100% category, second preference you give to 50% category. Okay. If there is a cash payment more than 2000, 80G itself not allowed. No deduction for donation in kind. Only if donation is given in money, it is allowed. If it is given in kind, it is not allowed. It is not allowed as deduction under section 80G. 80JJAA. So both old tax as well as new tax, the assessee can claim 80JJAA deduction. 80JJAA deduction is for whom? It is for the businesses who want to take deduction for the additional employees in that particular business. So any person, eligible assessee, who is eligible? Any person to whom 44AB applies and has PGBP income. So a person who has a turnover of more than 1 crore and the person is also having PGBP income under head PGBP, for them only 80JJAA is applicable. What is the deduction, sir? 30% of the additional employee cost during the previous year for 3 consecutive assessment years. 80JJAA is not a one-time deduction, it is allowed every year. Now listen, 30% of additional employee cost. So here I can also say that it is a weighted deduction. Weighted deduction eppadina, listen, whatever new employees are there no during the year, for all those new employees, whatever salary you are paying, 30% of that salary can be taken as deduction for 3 years. So 30% in year 1, 30% year 2, 30% in year 3. But 30% year 1, year 2, year 3, and in normally in profit and loss also you are taking deduction. So this is a double deduction that you are taking. There also you are taking deduction on salary. Here also you are taking deduction on salary. So additional employee. Who is an additional employee? In case of an existing business, it is the increase in the number of employees from the total employees employed as on the last day of the preceding year, plus emolument should be through account pay check, account pay bank draft, ECS or any other prescribed mode. Okay. So additional employee means what? See the number of employees in this year, see the number of employees in last year. From last year to this year, what is the increase in the number of employees? That is the additional number of employees. Sir, some employees would have quit the organization also. Correct? Adu less pannu. Purida. So last year, as on the last day, how many employees were there? This year, how many employees are there? Difference is equal to additional increase in the number of employees for existing business. This is for what? Existing business. Sir, what about new business? See, in new business, all employees are additional employees. In new business, all the employees are additional employees only. So emolument paid during the previous year and account pay check, account pay bank draft. So payment should be made through prescribed mode only. Now, see here, this new business I told you, no? In new business, the business should not be formed by splitting up or reconstruction of existing business. See, people can do fraud. What people will do? They will just open the same business in a new brand name, open a new branch account, or the same business will be there. They will rebrand it or rename it or restructure it to another business, and they will tell that this is a new business. Like that you should not do, because this is a huge deduction. All the employees, for all the employees, 30% of the salary you are claiming as deduction. Okay. Then business should not be acquired by the assessee by way of transfer from any other person or as a result of business reorganization. And report of chartered accountant should be given. For this section also, report of chartered accountant is compulsory before 1 month, prior to 1 month before the due date of filing return of income. Now, what did I tell you? that whatever salary is paid to new employees or whatever salary is paid to increase in the number of employees, 30% of that salary you can claim it as deduction for 3 years, not even 1 year. For 3 years you can claim it as deduction. Sir, next year also can I claim? Answer is yes. Next year, previous year's employee or salary that you will claim as deduction, correct? That is second year. And next year also there will be some new employee, no? For that also you can claim first year. So previous employee, previous year or second year you will claim, then current year or first year you will claim, like that it will go on. Year after year you can keep claiming, no problem. Okay. But exam la generally enna kudupanga, new business ah kudupanga. Then there will not be any confusion of who were there in the last year, then who are coming in this year, evlo previous year or the ipo evlo kudukanum, adalla exam la generally kekka matanga. Now, who are not included in this employee definition? Who are not included? Number 1, employee whose total emolument na enna salary. Emolument means what? Salary. Whose total emolument is more than 25,000 per month. So if the salary is more than 25,000 per month, those employees will not be considered. அந்த அளவுக்கெல்லாம் deduction கொடுக்க முடியாது. Okay, if the employee salary is exceeding 25,000 per month, those employees are not included, or for whom the entire contribution is paid by the government under the employee pension scheme notified in accordance with the provisions of the Employee Provident Fund and Miscellaneous Provisions Act 1952. Basically government employee. Government வந்து அந்த எம்ப்ளாய்க்கு PF கட்டுறாங்க. If government is paying the PF for the employee, then it is not, such employees are not covered because the government does not want deduction under 80JJAA. Next, who does not participate in recognized provident scheme. So whoever are the new employees should also participate in the RPF, recognized provident fund. The new employee should compulsorily participate in RPF. And next, employed for a period of at least 240 days during the previous year. At least 240 days during the previous year. Sir, less than 240 days now what will happen? Then consider them as new employee in the next year. Okay. If it is less than 240, consider them as a new employee in the next year. Don't consider in the previous year. But in the case of assessee engaged in the business of manufacturing of apparel or footwear or leather products, instead of 240, you should take it as 150. If they are working as 150 days during the previous year, then they will be considered for the purpose of deduction, new employee. So now what did I tell you? That to claim the deduction, there should be a business, PGBP income should be there, their turnover should be more than 1 crore, then only they can claim the deduction. To claim the deduction, if it is a new business, then a salary of all the business can be claimed as deduction. If it's a existing business, then only increase in the number of employees, for those employees alone salary can be claimed as deduction. What is the deduction? 30% of salary for 3 years will be allowed as deduction. Now what is, in this also the salary should be paid through prescribed mode of payment only, account pay check, account pay bank draft, electronic clearing system. And here who and all are not included in the employee definition? Number 1, if an employee salary is more than 25,000, they are not included in employee definition. Number 2, their entire contribution of PF is paid by the government. It means what? Government employees are not coming under this section because the government does not want deduction karna. Number 3, if the employee is not a part of RPF, they are not included. So definitely they should be part of RPF. And then number 4, if they are employed for less than 240 or 150 days. 240 days normal case, 150 days in case of what? Apparel, footwear, leather product manufacturing. Apparel, footwear or leather product manufacturing, it is 150 days. Sir, what if it is less than 140, 240 or 150? They will be considered as new employee in next year. So if an employee is employed during the previous year for less than 240 or 150, but employed for a period of 240 or 150 as the case may be in the immediately succeeding year, so next year they should be employed for 240 or 150 more, then he shall be deemed to have been employed in the succeeding year. Hence the employer would be entitled to deduction of 30% in the succeeding year. So in the verse of 240 150 not satisfying, but next year it is satisfying 240 150, then treat them as a new employee in the next year. Okay. Then what is not included in salary? What is not included in salary? Number 1, contribution by employer to a pension fund or PF. So PF contribution by employer. Here you can write employer contribution to any fund should not be included in salary. Then this lump sum paid, no, this is nothing but retirement benefit. Should not be included. So employer contribution not included in salary, retirement benefit not included in salary. All the others will be included in salary. Let us continue with the deductions. So we had completed till, we have covered all the major deductions. One major deduction is still remaining, 80 CCH. It is not major, that is also simple, but that is comparatively new. Hence I feel it is important. Now let us see section 80 DD. 80 DD. DD stands for disabled dependent. DD disabled dependent. Eligible assessee, individual HUF for dependent relative only, not for self. Normal disability, severe disability. Okay, listen. Section 80 DD, medical treatment of disabled dependent relative. Now this section is applicable only if the individual is having a relative and that relative is dependent on that individual and that relative is disabled. There are two types of disability, normal disability and severe disability. Normal disability less than 80% organ damage, then severe disability more than 80% organ damage. So in case of, now when is the individual eligible to claim deduction? If the individual is depositing some amount for the purpose of this relative. If the individual is depositing some amount for the purpose of this relative or for the benefit of this relative, this individual can claim a deduction of flat 75,000 or flat 1,25,000. 75,000 in case of normal disability, 1,25,000 in case of severe disability. Here you have to be very careful that this section is applicable only in case of dependent relative. It is not for self. So if I myself am disabled, then what can I do? I can claim deduction in 80U. I need not come to 80DD. If I myself am disabled, then I will go to 80U. I will not come to 80DD. 80DD is for what? Disabled dependent relative. Dependent relative. Now who is a relative? Relative is spouse, children, parents, brothers or sisters, and they should be dependent. They should be dependent. In such case, what should the individual do? Individual should deposit some amount in a policy which will give benefit to that particular relative. In such case, the deduction can be claimed 75,000 or 1,25,000. See, this is not upper limit karna, this is a flat deduction. Flat 75, flat 1,25,000. Now this deposit and all not that relevant from exam point of view. If you go through also okay, if you don't go through also it is okay. Then 80U. 80U is only for self. 80U is for self. Disability is defined under Person with Disability and Equal Opportunity Protection of Rights and Full Participation Act 1995. In the act per nyamba vechukunuma vanda. Sir, disability, what and all disability is covered? It will be given in question that it is a 80U disability. You will be able to answer. Then what are the limits? Limits deduction, it is same as 80DD. 75,000 in case of normal disability, 1,25,000 in case of severe. Section 80U. So section 80U is for self, section DD is for dependent disabled relative. Okay. Sir, for 80DD you told that the individual should deposit some amount for the benefit of that particular individual in some scheme, correct? But in 80U is there any such condition? Answer is no. Just if you are disabled, you can take the benefit of 80U deduction, that's it, no other condition. Then 80DDB. 80DDB is for specified diseases. Eligible assessee individual HUF for whom self and relatives. Relative is definition is same as 80DD. Deduction is what? Actual medical expense for the specified disease, or 40,000 in case of normal and 1 lakh in case of senior citizen. Means not a senior citizen means 40,000 maximum limit. Senior citizen means 1 lakh is the maximum limit, whichever is lower. Minus insurance claim received. So if insurance claim is received for medical treatment, that you have to reduce. On balance amount, you have to see whether it is within the limit. If it is above the limit, then maximum up to the limit only you can claim as deduction. What is the limit? 40,000 in case of non-senior citizen, 1 lakh in case of senior citizen. In case of specified disease, it will be given in question if it is a specified disease. So no need to see what and all are the diseases which are covered. Next, section 80E, interest on loan for higher education. This is what? Education loan. Eligible assessee individual. Conditions, loan should be for higher education. It means what? After class 12, college for degree, the loan should be taken. Loan should be from financial institution or charitable organization under section 80G. So I can take from bank, or I can take from 80G charitable institution, I can take a loan. Loan can be for self, spouse, children, or student for whom the assessee is guardian. Self, spouse, children, or a student for whom the assessee is a guardian. Period of deduction 8 years or years till which the interest is paid, whichever is earlier. So maximum up to 8 years you can claim the interest on education loan as deduction. This education loan should be for the purpose of higher education. Higher education means what? After 12th standard, that is college education. For college education, if you are taking loan, then interest on such loan can be claimed as deduction. This loan should be taken for whose education? For individual, spouse, children, or student for whom the assessee is a guardian. Loan should be taken from whom? Loan should be taken either from financial institution or from charitable institution. Okay, well, maximum for what period this interest is allowed as deduction? Maximum 8 years. Then 80EE, interest on loan for acquisition of residential house. If a loan is taken for acquisition of residential house, sir, but if the loan is taken for acquisition of residential house, already interest is allowed as deduction in 24B, then why are we studying 80EE? This is an extra deduction that is given. This is an extra deduction. So first to claim interest as deduction under 24B, whatever balance interest you can claim it here. Okay. Eligible assessee individual. But listen, this deduction is allowed only if the person has taken loan between 1/4/2016 to 31/3/17. Loan between 1/4/2016 to 31/3/17. So these and all are not that important. If at all it is they want to make the paper difficult, if they ask it, you should be in a position to answer. Interest on loan for acquisition of residential house. The housing loan should have been taken between 1/4/2016 to 31/3/2017. Eligible assessee is whom? Only individual. Conditions, loan should be taken for purchase of residential house. Loan should be from financial institution or housing finance company. Value of loan should be maximum 35 lakhs. Value of house should be maximum 50 lakhs. And assessee should not own any house before sanction of loan. What is maximum deduction? 50,000. So up to 2 lakhs you claim in 24B. Balance amount you claim in 80EE. Over and above the interest allowed in house property. Period till the repayment continues. So till you continue repayment, you can keep claiming the interest under section 80EE. Okay. 80EEA. Interest on loan for residential house. Sir, already we studied interest on loan for residential house. That is for loan sanctioned between 1/4/2016 to 31/3/2017. This is for loan sanctioned between 1/4/2019 to 31/3/2022. Okay, this is for loan sanctioned between 1/4/19 to 31/3/2022. Who is eligible? Individual is eligible. What are the condition? Loan should be for purchase of residential house. That is same. Loan should be from financial institution or housing finance company. That is also same. Stamp duty value should be up to 45 lakhs. This is a different condition. Stamp duty value should be up to 45 lakhs. Earlier what did we see? value of house should be 50 lakhs, loan should be 35 lakhs. Here what they are telling, loan value there is no limit at all, only stamp duty value 45 lakhs limit is there. Loan should be sanctioned between 1/4/2019 to 31/3/2022. Assessee should not own any house before sanction of loan. Maximum deduction is 1,50,000. So this is a change, different point. There 50,000 was allowed, here 150 is allowed. There it was 30 or 55 limit, here it is 45 limit. So if you know the differences, you will be able to answer easier, in a easier manner. Okay. Then period till the repayment continues. Next, 80EEB, interest on loan taken for acquisition of electric vehicle. Sir, if the electric vehicle is taken for the purpose of business, then interest on loan can be claimed under PGBP chapter. If it is not taken for business, if it's a personal electric vehicle, in such case the loan interest you can claim in this section. Okay. Eligible assessee, individual. Condition, loan should be taken for acquisition of electric vehicle. Loan should be from financial institution. Period of loan is 1/4/19 to 31/3/2023. Deduction is maximum 1,50,000. Period till the repayment continues. Interest allowed under this section will not be allowed under any other section. Okay. Next, 80GG, rent paid and HRA not received. Sir, the employees are there, no, they are getting HRA benefit, but I am not employee, I am not having any boss. So for me there is no HRA benefit. In such case you can take benefit of HRA under section 80GG. Condition, what is the condition? That assessee should not be getting any HRA. If the assessee is not getting HRA, assessee can use section 80GG. Then accommodation should be used for own residence. Accommodation should be used for own residence. So the assessee himself or herself should be staying in that accommodation. Assessee, spouse, minor child, HUF should not own any other accommodation at same place where he resides or works. So that the ownership of same accommodation in the same city should not be there. By whom? Assessee, spouse, minor child or even HUF. Then file a declaration of above detail along with return of income. Just declare that I am not having any other house in the city. I am on a rented house. I am only staying in the rented house. That is why I will claim the deduction of 80GG. Now what is the maximum deduction? Actual rent minus 10% of total income, then 25% of total income, or 5,000 rupees per month, whichever is lower. Actual rent minus 10% of total income, 25% of total income, or 5,000 rupees per month. So 5,000 rupees per month means what? Maximum 60,000 can be claimed as deduction. Now 80GGA. Sir, you told that in PGBP, business or profession, if you contribute for scientific research, 100% you can claim as deduction. But I am not having business, still I am contributing for scientific research. Can I claim deduction? Answer is yes, you can claim under section 80GGA. Donation for scientific research and rural development. Any assessee not having income under PGBP and makes donation for scientific research and rural development. Condition, donation for scientific research and social statistical research to organization approved under section 35. Same conditions. Donation for rural development to organization approved under section 35 CCA. This is not applicable for you. Deduction won't be denied merely because after donation approval was withdrawn. So while giving the donation, you should make sure it is approved. After giving the donation, if the approval is withdrawn, it is not your mistake. So it will be allowed as deduction. Donation of more than 2,000 should be in any mode other than cash. Any mode other than cash. Then 80GGB, 80GGC, donation to political party. 80GGB it is only for Indian company. 80GGC is for assessee other than Indian company, local authority, AJP funded by the government. See, local authority, obviously it will be ruled by a political party only. So they are not allowing this deduction to local authority. If they allow this deduction means they will contribute to their party and claim more and more deduction. And also, if any artificial juridical person is funded by the government, then obviously there will be party influence. Hence, for them also it is not allowed. So to Indian company, it is allowed under 80GGB. Other than Indian company, local authority and AJP funded by the government, it is allowed under 80GGC. Sir, what is allowed, sir? Entire political contribution is allowed as deduction, subject to the fact that it should not be in cash. If it is in any mode other than cash, it is fully allowed. No limit. Fully allowed. there are some people who take advantage of this only. I have seen in practically that there are political parties which are existing just because people want to claim this deduction 80 GGB and 80 GGC. There is no upper limit, no 5 lakh, 10 lakh, 20 lakh, how much ever you want you can claim deduction. So they will give to the political party as donation. They will collect the same amount in cash. Okay, and political parties will be having huge cash. So that cash, they will get rid of the cash, and now they will be having white money in hands, which they can legally show that this is our donation and we can use it for political purposes. So win-win situation for both of them. Like that people are doing. But if the assessee is caught red-handed, then huge severe consequences. Next, 80 CCH. 80 CCH. Deduction in respect of contribution to Agnipath scheme. Agnipath scheme. See Karna, Agnipath scheme is a scheme which was brought out by central government. By this scheme, the central government wants to recruit the people for armed forces. So they are taking in recruiting people in the under the Agnipath scheme. So first you have to be under the Agnipath scheme for 4 years, and after 4 years then the government will decide whether you want to continue in the army or you don't want to continue in army. Okay, so first 4 years you have to be in Agnipath scheme. After that the government will decide whether you want to continue or not. So for example, if 100 people are there, 15 people only will go in army, 80 people, 85 people will be asked to quit the army, under Agnipath scheme. So now for this 4 years, obviously if I am joining the army, there is high chance that the government will ask me to get lost after 4 years. So there should be some benefit, no? That is why benefit is given under Agnipath scheme. What is the benefit given? The benefit given is that as a young person, if you join the Agnipath scheme and if you are coming into the army, for 4 years you have to compulsorily serve. During that 4 years, 30% of your salary will go into Agnipath fund. Okay, Agnipath fund, a corpus fund, Agniveer corpus fund, and 30% the government also will contribute from their side in Agniveer corpus fund for 4 years. At the end of the 4 years, lump sum amount along with interest they will give. So 4 years after serving there, you will get a good amount. With that, if you are not in the army, then you can use that amount to do whatever you want later on, to start a business or anything else. Okay. Now, what is the specialty from the income tax point of view? From the income tax point of view, Nokanna, let us see quantum of deduction. 80 CCH subsection 1, deduction for the amount paid or deposited by the assessee being an individual enrolled in Agnipath scheme and subscribing to Agniveer corpus fund on or after 1/11/2022. Deduction under section 80 CCH would be available to an individual if he has exercised the option of shifting out of the default tax regime. So 80 CCH subsection 1 is for employee contribution, subsection 2 is for employer contribution. CCH 1 is available only in old tax regime. CCH 2 is available in both old tax as well as new tax regime. Okay, is there any upper limit? Answer is no, there is no upper limit. Whatever amount is contributed in the scheme fully will be allowed as deduction. Okay, then section 80 CCH2, whole amount of contribution made by the central government to the said account of the assessee in the Agniveer corpus fund is allowed as a deduction in computation of total income. Entire central government contribution to Agniveer corpus fund would be included in the salary of the assessee. However, deduction in 80 CCH2 would be available for the same. Now listen, what you have to do, if at all there is employer contribution, okay, he is a central government employee, employer contribution is there, then what you have to do, first add it to salary, first add it in salary and then claim deduction. So employer contribution, first add it to salary and then claim it as deduction. Then section 17(1), only as per perquisites, whatever contribution is made by the employer to the Agniveer corpus fund, that should be added to salary. And then section 10 clause 12C, payment received from Agniveer corpus fund is fully exempt. So after 4 years the person will receive the amount, no, including interest, it is fully exempt, So this is only Agniveer corpus fund. Now let us see other income based deduction, 80 QQB and 80 RRB. 80 QQB is for royalty, copyright fees on certain books of literary, artistic or scientific nature. Literary, artistic or scientific nature. See, for this Agnivir Corpus Fund, no, you can just draw this table, small table. It will be easier for you to remember. Employee contribution deduction under 80 CCH subsection 1 only allowed in old regime. Employer contribution added to salary first, then claim deduction under 80 CCH 2 allowed in both old regime as well as new regime, and the maturity amount is exempt under section 1012C, both old regime as well as new regime. Fine. Now let's come to royalty. Royalty or copyright fees on certain books of literary, artistic or scientific nature. So royalty on books. Royalty on books. 80 QQB is royalty on books. Eligible assessee only resident individual. No other assessee is eligible for deduction. Only resident individual. What is total deduction is how much? Eligible royalty or 3 lakhs whichever is lower. Eligible royalty or 3 lakhs whichever is lower. Eligible royalty means what? If a lump sum amount is received, then the amount received is only eligible royalty. Sir, if lump sum amount is not received, then 15% of book value of book sold. 15% of value of book sold is eligible royalty. So books will be sold, no, out of that whatever amount will come, 15% is eligible royalty. So if you are getting up to 15%, then fully eligible. More than 15% na, maximum 15 is only eligible. Okay, lump sum amount is received, fully eligible. Then what you should do? Eligible royalty or 3 lakhs whichever is lower will be deduction. See, students, what they will do, you know, they will claim the deduction correctly, everything will be correct, but what they will do a silly mistake, they will forget to add it to income from other sources income. So first add to income, add royalty in IFOS, then claim deduction. Silly mistake you should not do. If the royalty is earned from outside India, then amount should be repatriated, means it should be brought into India in convertible foreign exchange within 6 months from the end of the previous year or time allowed by RBI, whichever is earlier. So if royalty is earned in foreign exchange, bring the foreign exchange into India within 6 months from end of the previous year. Within 6 months from end of the previous year. Or if RBI allows extra time, then take the extra time, no problem. Then next, 80 RRB, royalty from patent. First what did we see? Royalty from books. Now we are seeing royalty from patent. Royalty from patent. It is eligible to whom? Resident individual. Here there is no concept of eligible royalty. Directly take the royalty or 3 lakh rupees, whichever is lower will be allowed as deduction. Here also same thing. First add it to the income and then only you should take the deduction. Directly don't take deduction. Royalty, if it is earned from outside India, same condition. Amount should be brought into India in convertible foreign exchange within 6 months from the end of the previous year or time allowed by RBI. Royalty does not include sale of product. Section 80 TTA, interest on saving bank account, one of the most common deductions. 80 TTA, interest on saving bank account. Who is eligible? Individual and HUF is eligible. Then what is the deduction? Interest received or 10,000, whichever is lower is the deduction. However, in case of post office interest, 3,500 shall be exempt while calculating the total income. So interest on saving bank account alone is included in this section. Is interest on FD included in 80 TTA? Answer is no. Interest on fixed deposit is not included in 80 TTA. 80 TTB, interest on deposits of senior citizen. Now for senior citizen, 80 TTB is applicable. 80 TTB is applicable for seniors, only for resident senior citizen. Only for resident senior citizen. Deduction is how much? Interest received or 50,000, whichever is lower. And listen here not only saving bank interest, here FD is also included. Saving bank interest, fixed deposit, recurring deposit, RD, that is also included. Okay, but the deposit should be with a banking company, cooperative bank or post office. Banking company, cooperative bank or post office. Now listen, if a resident senior citizen, only this 80 TTB is only for whom? Resident senior citizen. Resident senior citizen. Up to 50,000 deduction can be claimed. This 50,000 includes not only saving bank interest, but it also includes fixed deposit interest and recurring deposit interest. Okay, wow. Now this senior citizen, can he take the benefit of 80 TTA also? Answer is no. If you take 80 TT B benefit, you are not eligible for 80 TT A benefit.